Somewhere in Texas, a family that made its money in cattle feed and cold storage warehouses is sitting on $5 million in real estate. Not a dollar more. No hedge fund, no IPO, no crypto wallet. Just land, buildings, and mortgages older than some of their grandchildren. And yet, 3 generations later, that same family is deploying capital like they're sitting on $500 million. Not because the property tripled in value, not because they sold anything. They didn't liquidate a single acre. So where did the other $495 million come from? That question is the whole reason you're watching this. Because the honest answer isn't a stock tip or a secret fund. It's a mechanism, a structure so unglamorous it doesn't even have a marketing department, and yet it's the actual engine behind more generational wealth than venture capital, private equity, and every get-rich course on the internet combined. It's called the family bank, and once you understand how it works, you'll never look at a piece of real estate the same way again. Here's the first thing you need to unlearn. A family bank is not a trust. It's not a holding company. It's not some vault with a velvet rope and a butler counting gold bars. A trust protects assets. A holding company organizes them. A family bank does something completely different. It turns assets into a lending institution that only serves one client list, the family itself. Think of it less like a Swiss vault and more like a private Federal Reserve, except instead of printing currency, it prints access. Access to capital, on demand, without ever touching the underlying asset that makes the whole thing possible. And that underlying asset, 9 times out of 10, is real estate. Not because real estate is exciting, it isn't. Nobody's putting a strip mall on a vision board. Real estate is boring on purpose, and that's precisely the point. Boring is stable. Boring is bankable. A commercial building doesn't have a bad quarter because a CEO tweeted something stupid. A warehouse doesn't get delisted. Land doesn't have an earnings call. Banks have spent over a century building lending infrastructure specifically designed around real estate because it's the one asset class that behaves the same way in a recession as it does in a boom. It just sits there, appreciating slowly, quietly, predictably, while everything else in the portfolio does gymnastics. That predictability is currency, literally, because predictable assets are the only assets that banks will lend heavily against, and lending heavily against an asset without selling it is the entire secret of a family bank. Here's the mechanism in its simplest form, and you can run this math yourself later if you don't believe it. Say a family owns a building worth $5 million, fully paid off. They don't sell it. Selling triggers taxes, kills the appreciation, and ends the relationship with the asset forever. Instead, they walk into a lender and borrow against it. Depending on the asset class and the relationship, banks will often lend 50 to 70% of the property's value without blinking. That's $2.5 to $3.5 million in cash, sitting in an account ready to deploy, while the family still owns 100% of the building. The building keeps appreciating, the rental income, if there is any, keeps flowing. And now there's millions in liquid capital that didn't exist yesterday, all without a single square foot changing hands. That's leverage, not the reckless kind you hear about right before a market crashes on the news. Controlled leverage, borrowed against an asset that isn't going anywhere, deployed into new opportunities, more real estate, private businesses, other collateral, that generate their own value, which can then be borrowed against again. One asset becomes the seed for two. Two become four. This is the part we'll break down piece by piece in the next section, the actual multiplier math that turns a starting number like $5 million into something that reads like a typo. For now, just sit with the shape of it, money that gets borrowed, deployed, and never repaid in the way you'd repay a normal loan, because the asset backing it keeps climbing in value faster than the interest accrues. This is where you have to separate two ideas that most people collapse into one, net worth on paper, and capital a family can actually put to work. Net worth is the number an appraiser writes down. It's real, but it's frozen. It's the value of the building if you sold it today, which you're never going to do because selling it kills the machine. Deployable capital is different. It's the money sitting in the account right now, borrowed against that frozen number, doing things, funding a new acquisition, capitalizing a business, backstopping a bet, while the frozen number underneath it keeps rising untouched. A family with $5 million in real estate and no understanding of this mechanism has $5 million. Full stop. A family that understands it has $5 million in equity and access to millions more in usable capital, capital that can be redeployed into assets that generate collateral of their own. Multiply that cycle across decades, across generations, across dozens of properties instead of one, and you start to see how $5 million stops being a ceiling and starts being a floor. The building never moved, the family never sold, and somehow the number on the balance sheet just kept climbing into territory that looks less like real estate and more like an actual bank. That's not an accident, and it's not luck. It's a machine with specific, learnable parts, and in the next section, we're taking it apart piece by piece to show you exactly how the multiplier works. Let's open the hood on this thing, because borrow against the building sounds simple until you actually watch the gears turn. And the gears are more interesting than almost anyone tells you. Start with valuation, because nothing moves until a bank agrees on what the building is worth. A bank doesn't just take your word for it. They send an appraiser who compares your property to recent sales of similar properties, factors in income if it's a commercial asset, checks the condition, the location, the lease terms if there are tenants, and lands on a number. Let's say that number is $5 million. That figure becomes the ceiling for everything that follows, because banks don't lend against what an asset might be worth someday. They lend against what it's worth today, verified on paper, in ink. From there comes the number that actually matters, loan to value, or LTV. This is the percentage of the appraised value a bank is willing to hand over in cash. For stabilized commercial real estate with steady cash flow, that's typically somewhere between 50 and 70%. Riskier assets get less. Blue chip, income-producing properties with a long track record and a family that's been banking with the same institution for 20 years? Sometimes you push higher. On our $5 million building, a 65% LTV means the bank will extend $3.25 million in borrowed capital while the family retains full ownership. No sale, no taxable event, no goodbye to a building that took 3 generations to pay off. Just a number that says, here's liquidity secured by an asset that isn't moving. Now here's where it gets interesting, because one building only gets you one loan. Families running an actual family bank rarely stop at one property, and this is where cross-collateralization enters the picture. Instead of pledging a single asset against a single loan, the family pledges a portfolio. Picture it like a group of friends co-signing for each other, except the friends are buildings, and each one strengthens the group's borrowing power instead of weakening it. A $5 million office building, a $3 million warehouse, and a $2 million retail strip held under one entity can be bundled together into a single credit facility. The bank looks at the combined value, roughly $10 million, applies its LTV, and issues a credit line closer to $6.5 million rather than 3 separate small loans totaling less. Lenders love this because their risk gets diversified across multiple asset types and locations. Families love it because it unlocks more capital per dollar of equity than any single property could on its own. One weak asset gets propped up by 2 strong ones. The portfolio becomes stronger than the sum of its parts, which is the entire point of running these properties as a system instead of a collection. But a credit line sitting unused is just a number on a piece of paper. The tool that actually turns frozen equity into spendable capital is the line of credit itself. For individuals, that's the HELOC you've probably heard mentioned in passing. For a family operating at scale, it's a commercial line of credit, sometimes structured through what's called a securities-backed or asset-backed lending facility. Functionally, they work the same way. The bank agrees to a maximum amount the family can borrow against the collateral, and the family draws down only what they need, when they need it, paying interest only on the portion actually used. It behaves less like a traditional loan and more like a reusable tank of fuel. Draw $1 million out to close on a new acquisition, pay it back over 18 months as cash flow comes in, and the full line resets, ready to be drawn again. This revolving structure is what separates a one-time cash-out refinance from an actual banking operation. A refinance is a single event. A credit line is a machine you can run over and over. So where does the money actually go once it's drawn? This is the redeployment step, and it's the part that turns leverage from a clever trick into a compounding engine. The family doesn't spend the $3.25 million on lifestyle. They spend it on acquisition. Say they find a new commercial property, another $5 million building, similar profile, similar income. They use the drawn capital as a down payment or, in cases where their credit and relationship with the lender are strong enough, as the entire purchase price, financing the rest through a separate mortgage on the new asset. Now the family owns 2 buildings instead of 1. Both appraise, both generate income, both sit as collateral. And both can now be pledged together for a new, larger credit facility. Let's run the numbers so you can see the shape of it rather than just take my word for it. Cycle 1, $5 million building, 65% LTV, yields $3.25 million in liquid capital. That capital gets deployed into a second property valued around $5 million, using a mix of the drawn credit and a fresh mortgage. Now the family's real estate base is $10 million instead of $5 million. Cycle 2, cross-collateralize both properties, apply that same 65% LTV against the combined $10 million, and the new available credit line jumps to $6.5 million. Deploy that into 2 more properties instead of 1, because now there's enough capital to diversify. The base grows again, this time to roughly $20 million. Cycle 3, same math, same discipline, and the collateral base pushes past $30 million, generating a credit facility north of $19 million, which gets redeployed into more income-producing assets, growing the base again. Run this pattern across 4 or 5 cycles over a decade, layering in actual property appreciation on top of the borrowing, and a starting point of $5 million in real estate mathematically walks itself toward $50 million in collateral value, without a single dollar of outside investment and without selling a single original asset. Notice what never happened in any of this. Nobody sold a building to fund the next one. Nobody liquidated equity and triggered a tax bill that would have eaten a third of the gain. The original $5 million asset just sat there, appreciating quietly, doing its boring job, while borrowed capital did the aggressive work of expansion. That's the multiplier, not a stock tip, not a market bet, just disciplined, repeated borrowing against a growing base of collateral, redeployed every cycle into assets that expand the base again. And once you can see the mechanism clearly at this scale, the jump from $50 to $500 million stops looking like magic. It starts looking like arithmetic, run patiently, across enough cycles and enough generations to let the multiplier do what multipliers do. So you've got $50 million in collateral value, built patiently over a decade, 4 or 5 cycles deep, without selling a single original building. That's an impressive number. But $50 million sitting in one person's name is fragile in a way that's easy to miss until something goes wrong. One lawsuit, one bad tenant slip and fall, one divorce, one estate battle after somebody passes without the right paperwork, and the whole structure is exposed to a single point of failure. This is where the legal architecture stops being boring paperwork and starts being the thing that actually lets this machine survive contact with real life. Families running this at scale almost never hold real estate in their own names. The properties sit inside LLCs, and the LLCs sit inside trusts. Think of the LLC as a locked box around each individual property. If a tenant sues over an injury in the warehouse, they're suing the LLC that owns the warehouse, not the family, not the other 19 properties, not the credit facility sitting behind all of it. The liability stays contained to the box it happened in. The trust sits one layer above that, holding the ownership interests in those LLCs, and this is the layer that actually controls succession. Instead of a will that triggers probate, taxes, and a courtroom every time someone dies, the trust just keeps functioning. Ownership transfers according to terms set decades earlier, quietly, without an event, without a sale, without the IRS getting a bite along the way. The building never technically changes hands in the way a taxable transfer would require. It just changes who benefits from it. This structure does something else too, something families rarely explain out loud, but that the banks absolutely notice. It lets you separate who's liable from who owns. A lender looking at a single landlord with $50 million in personal real estate sees concentration risk. One person, one balance sheet, one bad year in one market, and the whole thing wobbles. A lender looking at a properly structured trust holding a dozen LLCs across multiple property types and multiple regions sees something completely different. They see a diversified portfolio wrapped in legal insulation, where no single asset's failure can drag down the rest. That distinction alone changes the terms you get offered. Now let's talk about what happens when a second generation actually enters the picture, because this is where the machine stops being a clever trick one person figured out and starts being an actual institution. The kids don't inherit a pile of cash, they inherit access. Access to a trust that holds equity in properties, access to relationships with lenders who've been dealing with this family for 15 years, and increasingly access to their own earning power, which becomes new collateral the moment they buy their first asset under the family umbrella. Say the next generation, using capital sourced through the family structure, acquires a $10 million apartment complex. That property doesn't sit off to the side as some personal side project. It gets folded into the same collateral pool, cross-collateralized alongside everything else, and suddenly the base isn't $50 million anymore. It's $60 million, and the borrowing capacity against it grows accordingly. Each generation isn't just receiving the machine, they're feeding it. This is also where intra-family loans start doing quiet, unglamorous work that makes the entire system tax efficient in a way outside financing never could be. Instead of a parent simply gifting a child capital to acquire property, which can trigger gift tax reporting and eats into lifetime exemption limits, the trust loans the money to the next generation at the IRS-mandated minimum interest rate, the applicable federal rate. In a lot of environments, that's somewhere between 2 and 4%, dramatically below what a commercial bank would charge for the same capital. The child uses that loan to acquire an asset, the asset generates income, the income services the interest on the loan back to the trust, and the principal effectively gets recycled inside the family system instead of leaking out to an outside lender who has no long-term stake in the family's success. Money moves down a generation, does its job, and the interest flows back up, all without a single taxable gift event triggering along the way. It's not a loophole, it's just structured patience, using rules that have existed for decades, applied deliberately instead of accidentally. Here's the part that makes the whole thing sustainable rather than just aggressive. None of this works if the debt has to be paid down out of pocket. The reason this machine doesn't collapse under its own leverage is that the properties themselves are doing the paying. Rental income covers the interest on every loan drawn against that property. Appreciation, even conservative appreciation, 3 or 4% a year compounded across a $60 million, then $100 million, then $200 million base, adds real, appraisable value that increases the ceiling for the next draw. The family isn't reaching into savings to service debt. The debt services itself, and the appreciation quietly raises how much more can be borrowed next cycle, which is the exact mechanism that turns this from an on-time maneuver into something closer to a perpetual motion machine, at least as close as finance ever gets to one. Run the numbers forward the same way we did to get from $5 to $50 million, and the path to $500 million stops looking exotic. Cycle 6 starts around $50 million in collateral. Cross-collateralized at 65% LTV, that throws off roughly $32 million in fresh capital, deployed into new acquisitions across generations, pushing the base past $80 million. Cycle 7, now with 2 generations actively acquiring and multiple property types spread across different regions, the base clears $150 million. Cycle 8, with intrafamily loans recycling capital efficiently and banks now treating this family as a blue-chip borrower rather than a risky concentrated one, the base pushes past $280 million. By the time you're 4 or 5 cycles deeper into this second phase, layering in a decade or two of appreciation on top of the borrowing, that $50 million foundation mathematically walks itself toward $500 million, the same arithmetic, just run across more collateral, more borrowers, and more time. None of this happened because someone got lucky in a hot market. It happened because a family stopped treating real estate as something you sell when you need cash and started treating it as permanent infrastructure that borrows on your behalf, generation after generation, while the buildings themselves quietly keep doing their job. Here's the part nobody puts in the pitch deck. Every mechanism we just walked through, the LLCs, the trusts, the cross-collateralization, the intrafamily loans, all of it runs beautifully in one direction. Values go up, borrowing capacity goes up, the machine feeds itself. But leverage doesn't know which direction the market is moving. It just multiplies whatever direction you're already going in. And that's the sentence families forget the moment the 10th cycle starts feeling routine. Picture the same $200 million base we built 2 cycles ago, cross-collateralized at 65% loan-to-value. In a rising market, that ratio is your engine. In a falling market, that same ratio becomes a tripwire. Say commercial real estate values in the family's core markets drop 20% over 18 months. It's happened before, it will happen again, and it doesn't need a financial crisis to do it. Sometimes it's just an oversupplied submarket, a major employer relocating, interest rates resetting cap rates across an entire asset class. That $200 million in collateral is suddenly worth $160 million on paper. The loans sitting against it, the ones sized off the old higher value, haven't shrunk at all. They're still $130 million. Your loan-to-value ratio, the number the bank actually watches, just jumped from 65% to over 81% without you selling anything, buying anything, or doing anything wrong at all. The market moved, the debt didn't. This is the moment a margin call letter shows up, and it's worth understanding exactly what that letter is asking for. It's not asking you to explain yourself. It's asking you to either inject fresh cash to bring the ratio back into compliance or start selling assets to pay down the loan balance until the math works again. And here's the trap hiding inside that second option. The properties in this portfolio were never built to be sold quickly. They were built to be held, refinanced, and borrowed against for decades. Commercial real estate takes months to sell under normal conditions, and in a downturn, when every other overleveraged family is trying to sell into the same falling market at the same time, months becomes a year, sometimes longer, and the price you get is a distressed price, not the appraisal you were counting on. This is illiquidity showing its teeth. On paper, the family looks worth $500 million. In reality, on the Tuesday the bank wants a wire transfer. That $500 million is sitting in buildings, in trusts, in structures that take time to convert into cash, and the bank does not care how patient your appreciation curve has historically been. It wants money now, at a value the market has already stopped agreeing to. Families who spent 15 years building an empire on buildings can find themselves forced to sell their best assets, not their weakest ones, because the best assets are the only ones a buyer will move fast on during a downturn. You end up liquidating the crown jewel to save the rest of the portfolio, which is precisely backward from the strategy that built the thing in the first place. Here's the mistake that creates this scenario almost every single time, and it's not greed, it's arithmetic nobody ran. Families scale their collateral base aggressively across generations, adding property after property, cousin after cousin, LLC after LLC, and they stress test the collateral value constantly. What's it worth today? What's it worth if it appreciates 4% a year? What's the new borrowing capacity next cycle? What almost nobody stress tests is debt service under a bad scenario. Not can the rental income cover the interest at today's occupancy and today's rates, but can it cover the interest if occupancy drops 15%, if a major tenant doesn't renew, if rates reset 2 points higher at refinance, and if 3 of these events happen in the same 18-month window instead of politely taking turns? A family running $300 million in cross-collateralized debt without ever modeling a simultaneous vacancy spike and a rate shock isn't being ambitious. It's flying with no instruments and calling it confidence. So here's the takeaway sitting underneath every cycle we've walked through in this entire video. Leverage is not a growth tool that occasionally carries risk as a side effect. Leverage is a magnifying glass, full stop, and a magnifying glass does not choose what it enlarges. It made the jump from $5 to $50 million look almost effortless, 4 or 5 cycles of borrowing against equity that kept climbing. It will make a downturn look catastrophic with exactly the same mechanical indifference because it's the identical multiplier running in reverse. The families who actually make it to $500 million and stay there aren't the ones who leverage the hardest. They're the ones who modeled the bad decade as carefully as they modeled the good one, who kept a liquidity cushion sitting outside the collateral pool specifically so a margin call never forces a fire sale, and who understood that the buildings paying for themselves only works when the income backing them can survive a genuinely bad year, not just an average one. And this is exactly the mistake that quietly bankrupts families who did everything else right. They cross-collateralize aggressively for 2-3 cycles, feel invincible because appreciation keeps bailing them out, skip the stress test because the spreadsheet without it looks so much better, and then a rate reset or a vacancy wave hits 18 to 24 months later, right when the debt is due for refinance, and forces a sale nobody modeled for at a price nobody wanted to accept. That single missing stress test has cost families tens of millions of dollars in forced sale losses, and it usually surfaces around month 20 of a downturn, right? When everyone assumed the worst was already behind them. If you want to see exactly how families structure the version of this that survives contact with a bad decade, the book walks through it in detail, and the link is right in the description.